Welcome to the Best Interest Podcast, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 90 of the Best Interest Podcast. My name is Jesse Kramer, and today we are bringing you another Ask Me Anything or AMA episode. As with the first two AMA episodes, which were episodes 81 and 86, all of these questions come from you, the listeners or the readers of the Best Interest blog. As always, you can send in your questions to jesse@bestinterest.blog. I try to read every single question. Sometimes I will just shoot off a quick reply. Sometimes I will save the questions for podcast episodes like this. But first, as always, we will start with a customary review of the week. This one comes from RV Guy Ed, and then a whole bunch of letters after that. Ed writes in, he says, I listen to a lot of personal finance and retirement podcasts, and I was blown away by the Best Interest. Jesse has a really solid understanding of finance and investing principles. He is thus able to explain issues in full, rather than taking a position and presenting as the only truth. The Best Interest has helped me to understand issues that I never had really felt I understood before. Keep up the good work, Jesse. Your podcast has made a big difference in my financial journey. Well, RV Guy Ed, I'm really happy about that. Thank you. I'm glad it's made a big difference in your financial journey. Thank you for those kind words, Ed. If you hear this, write to me, jesse@bestinterest.blog, and we'll get you hooked up with a super soft Best Interest t-shirt. And with that, let's begin the AMA episode. The first question comes from Lynn. Lynn's question, in short, is when should I take Social Security? Lynn assumed that she and her husband would wait until age 70 to maximize their benefits, but they aren't sure if that's the right strategy. Both of their families tend to live a long time with grandparents and parents who have passed away at ripe old ages. But I think Lynn's question really opens up a broader question, which is when should I take Social Security? In fact, when Lynn originally wrote in, I decided to write a pretty comprehensive article, which I titled, When Should I Take Social Security? We will link to that article in the show notes, but I'm going to read some of the highlights to answer Lynn's question today. So now, the background for any of you listening who are either not super familiar with the Social Security system, or maybe you haven't had to go into the details yourself yet. Social Security is a government program that provides financial support to individuals who are retired, disabled, survivors of deceased workers, and it's funded primarily through payroll taxes. Social Security aims to ensure financial stability, economic stability, and security for eligible participants by offering them benefits to mitigate income loss, right, due to either retirement, leaving the workforce, disability, or death. And today we're talking about retirees. For the most part in the financial planning world, we're talking about retiree benefits for Social Security. American retirees each have an eligible benefit from Social Security, which is based on the following factors. They must be 62 years old or older to begin collecting. They must have worked and paid into the Social Security system for at least 10 years, and that's measured quarterly for a total of 40 quarterly credits. They could be eligible for additional credits based on their spouse's work history too, which is important, right? Not every family has two working parents, or two working adults, I should say. And just because one adult or parent chooses to, say, stay home with the kids, doesn't mean that they should be excluded from the Social Security system. And then the eligible benefit is determined by an individual's highest 35 years worth of earnings, with each year of earnings being adjusted for inflation. That's called indexing. They'll say it's indexed for inflation. So the higher someone's overall earnings, the greater their Social Security benefit will be. There are a couple important terms that we do need to define here when it comes to Social Security. The first term is AIME, or AIME, which is the average indexed monthly earnings. And as the name probably describes, AIME is when we look at someone's work history and we take all those 35 years of earnings, which if they don't have 35 years, well, then some of those years are counted as a zero. We adjust each year by inflation, find the average, divide it by 12, and that's how we get the average indexed monthly earnings for an individual. And then there's this other term, PIA, PIA, or the primary insurance amount. And that is essentially what someone will actually receive from Social Security if they retire at full retirement age, or FRA. So PIA is the real deal. An individual's Social Security benefits, or PIA, are based on a specific percentage of that individual's AIM, or their average indexed monthly earnings. Now, there's a pretty interesting relationship between AIM and PIA that is much easier to understand if you can see the numbers on a screen, if you can see the graph on a screen. And I'm not going to dive into the specific numbers here, but what I am going to say is that not all of your AIM dollars count the same. The first dollars matter a lot. The latter dollars matter very little. And for very high earners, in fact, their latter dollars don't count at all. So this concept is called the Social Security bend points. And for what it's worth, if you go to this article with the link in the show notes, you can see these numbers. You can see the graph of the Social Security bend points. And essentially what it means is that lower income earners or middle class income earners, they still get a pretty significant Social Security benefit because their AIM dollars, their average indexed monthly earnings, still counts quite a bit toward their eventual PIA Social Security benefit. But very, very high income earners, well, sure, they still fill up those lower buckets, just like the lower income earners do. But the higher buckets don't really matter much when it comes to Social Security. And that's why really high income earners, it's not like they're collecting millions of dollars of Social Security benefits. They're capped at a pretty reasonable low amount of Social Security. So anyway, it's just worth understanding. We already talked about this concept of full retirement age, or FRA. Full retirement age, it depends on what year you were born. But for most of today's retirees, people who are either just entering retirement or will be entering retirement soon, their full retirement age is either 66 or 67 years old, or potentially 66 and 2 months or 66 and 4 months, that kind of thing. Depends on what year they were born. And if anything, the government potentially will continue to increase full retirement age as time goes on. And again, as a reminder, full retirement age is the age at which you can start collecting your Social Security benefits in full. If you decide to start collecting Social Security benefits early, there's a penalty to pay. You're only going to collect 70 or 75 or 80% of your benefits, and it depends on the age. If you wait until after full retirement age, so you can wait until after you're 66 or after you're 67, you get a bonus. You actually start to collect 108 or 116 or 124% of your Social Security benefits. And that brings up an important question, which is there a break-even point? Of course there is, but when is the break-even point? So the break-even point for collecting Social Security, it's about age 78, 79, 80. The lines all kind of intersect around there. So the idea there is if you die before age 77, collecting as early as possible would have been best. If you die after age 80, then waiting until, as long as possible, waiting till age 70 to start collecting would have been best. Of course, the problem is when you're sitting there at age 62 or 63 or 64, you don't really know when you're going to die. We don't have a crystal ball. And the joke, of course, is you tell me when you're going to die, I'll tell you when to start collecting Social Security. Well, we don't know that, so we have to make some educated guesses. This is hard to get right. Annie Duke's quote, which I love to repeat, the two things that determine the outcomes in our life are the quality of our decisions and luck. Well, we can't control luck, but we can try to control the quality of our decisions. And whatever decision you make regarding Social Security, you have to accept the fact that bad luck might strike, and your decision in hindsight will not have been an optimal one. It's not because you made a bad decision. It's just because you had some bad luck. So anyway, we have to accept that in Social Security. You do want to try to get this right. Social Security is close to a one-way gate. Now, technically speaking, once you start collecting, you actually do have up to 12 months to either change your mind. Well, I shouldn't say either change your mind. You can change your mind, in which case you'll have to repay the benefits that you've received so far. You get one of these takebacks in your lifetime. Once you delay collecting, though, you can't go back in time and reclaim the benefits that you've missed. So ideally, you figure out all your details and you try to make a smart decision the first time. Okay, but what goes into making a smart decision? First off, I would start with health and illness and family history. The most common questions surrounding Social Security revolve around your personal health and your family history. You know, we've already determined here that ages in the late 70s to early 80s, that's the break-even point. So you should ask, does anything in your personal or family history point you toward an early or late death? If you're healthy and all your relatives live to 100, well, postponing Social Security as long as possible makes sense. If you're chronically ill, if your relatives have all passed away early, again, you can reasonably assume that you might have a similar fate, and collecting Social Security as early as possible makes sense. Granted, I'm not a doctor, I'm not a medical professional, and there's this one health phrase that I like and I think is worth remembering here, which is that genetics loads the gun, but environment pulls the trigger. In other words, you aren't condemned, you aren't destined to repeat your family history. You do have dials to control, so don't forget that. Another question to ask on the Social Security: do you need Social Security? It does act as longevity insurance if you wait. The extra income can bridge the gap between living a pretty bad life and living an okay life. So if you don't need Social Security at age 62, why take it early? The longer you wait, the higher your benefit will be, and the better your long-term outcomes will be. Another question to ask: are you still planning to work? If you are planning to work while also collecting Social Security, tread carefully. Your work income could actively eat away at your Social Security benefits. Specifically, if you start collecting Social Security before your full retirement age, and during those years before full retirement age, you continue to work, your W-2 income, the paid income that you receive, will actually reduce the amount of Social Security benefit that you'll receive during those years. Another important question: consider spousal benefits. This one, we've talked about this before here on the podcast. The summary is that your decision to collect Social Security not only affects you, but could affect your current spouse, your ex-spouse, or even a future spouse or future widow. So make sure you understand spousal benefits. And we did talk about spousal benefits quite in detail in a previous AMA, episode 86. We answered a question about a widow who was considering remarrying. We talked about survivor benefits, and we went really in depth there. So I'd point you to 86 if you want to learn more about spousal benefits. Another question: what about the overall financial plan and sequence of returns risk? So the question to ask is, how does Social Security fit into your overall financial plan, your presumed retirement income and cash flow, and specifically in the early years of retirement, where you're most at risk for the sequence of returns risk, which we talked about in depth both in episode 88 with Tyler from Portfolio Charts and in episode 89 with Rob Berger. So if you want to learn about sequence of returns risk, go check out episodes 88 or 89. You should ask yourself taxability questions. Social Security is taxable for many retirees, and it's worth considering if your decision to collect Social Security, especially early, will have taxation impacts on what your net of tax benefits actually are. What do your trusted advisors have to say? Every single retirement is a unique adventure, but those adventures often rhyme with one another. So your advisors, whether it's an accountant, an attorney, a CFP, someone like that, have probably seen dozens or hundreds of successful retirements before, which all might rhyme with what's going on in your plan. So their counsel might sway you in an optimal direction. So Lynn, good luck with your Social Security adventure. Hopefully those tips and tricks will help you out. The next question comes from Yogi. Yogi, thank you for the excellent question. And Yogi's sent in a bunch of fantastic questions, and I just decided to pick one that I thought was interesting and unique, and we haven't talked about it too much before. So Yogi's question has to do with an ESPP plan, an employee stock purchase plan, ESPP. And Yogi says, my employer offers an ESPP for 5%, which has no look-back period. And don't worry, everybody, we will define these things, with an enrollment option of up to 15% of my paycheck. The company's not been doing very well since its all-time high in March of 2019. I had heard a friend told me that the 5% discount, while not huge, would be free money. But I also worry about the opportunity cost when I could be investing in my long-term portfolio. So Jesse, what are the main things that need to be considered when deciding if and how much I should be enrolling? Okay, so let's first, before we really answer Yogi's question, we need to define a bit of Yogi's question for all of you listening. An ESPP, an employee stock purchase plan, is a company-run program in which employees can choose to participate, but participating employees can purchase company stock directly, typically at a discounted price. The discount rate on company shares depends on the plan, but it can be as much as 15% lower than the market price. And some ESPPs have this thing called a look-back provision, which Yogi said his doesn't have a look-back provision. But what the look-back provision allows is it allows for the plan to use a previous historical closing price of the stock. The price used is typically either the price of the stock on the offering date itself or sometime in the last quarter. And so, okay, so really what are we talking about here? Can we apply maybe a real world example? Sure. What might a typical ESPP look like? I think that might help apply some of these definitions into a real world situation. So a typical ESPP would say, well, at the end of every quarter, our employees are allowed to take a certain percentage of their quarterly income that they've earned, and they can buy our company stock with it. What is the price that we use for the company stock? Well, it's either the price today, here on this day at the end of the quarter, or quite often there's a look back period where the company says, we're actually going to pick the lowest price from the past 90 days, from the past quarter. And that's the price that you get to pay, that you get to buy our stock at. In fact, sometimes a company will say, we're even going to discount shares further below that. I think in Yogi's case, he was saying that there is a 5% discount. In Yogi's specific case, there is no look back period. So simply what they say is, we're going to take the price here at the last day of the quarter, and we're going to chop off 5%. And we're going to allow you, Yogi, and all your coworkers to buy our stock at a 5% discount today. And in Yogi's case, he can divert up to 15% of his income to buy that stock. So that's roughly how ESPPs work. Some ESPPs are qualified, meaning they have terrific tax treatment, just like a 401k might. Others are non-qualified, which is more like a typical taxable brokerage account where there are capital gains and dividend taxes to pay if you hold the assets there over the long period of time. That said, the taxation rules for ESPPs can be kind of complex. And in general, a person will be taxed on any stock they purchase through an ESPP during the year that they sell that stock. And that can be counted either as some form of taxable income, or if the stock price has gone down from the time of purchase, it could be counted as a deductible capital loss. And of course, the difference between what you paid for the stock and what you received when you sell the stock is that capital gain or capital loss. Another important small tax factor is that any discount offered to the original stock price, that is taxed as ordinary income. In Yogi's case, right, he has this 5% discount. So let's say the stock is trading at $100 today. Yogi has the opportunity to buy the stock at $95. Let's say he does that 10 times. He got $5 off on each one, so he got a $50 discount. Well, he's going to be taxed as if he just earned $50 of ordinary income. The discount itself is taxed. If Yogi chooses to sell his stocks after he buys them, right? He can buy them at a discount. And if he wants to, he can immediately turn around and sell them. He can wait a little while to sell them. He can hold them forever and eventually sell them. The entire gain will be taxed in some way, shape, or form. So in Yogi's case, he could buy the stock today. He does have to pay income tax on the discount that he receives, but ostensibly he could take today's $95 purchase, he could turn around and sell it at $100, and he can pocket the 5% difference, less the taxes that he owes. Otherwise, the value of the stock can go up, which would increase his profits, or it might go down, which would cause Yogi essentially to lose money. However, if Yogi does wait for at least a year, then he'll receive a more beneficial tax treatment. So the main considerations here, I don't have an ESPP plan, but if I did, or for clients who do, is what's really more important, or for people I work with who do, the main considerations are, does our individual have a holding period in mind? Are they subjecting themselves to too much market risk or concentration risk by holding one stock in their portfolio, too much of one stock in their portfolio for too long? Not to mention, it's the one stock that also is cutting their paycheck. And it's a very common thing you see with concentrated portfolio holdings. It's very common in especially today's kind of tech-heavy world where options, RSUs, ESPP plans, all these things will cause an employee to have a pretty high position, a pretty concentrated position in their employer. And the kind of things that could affect the employer's stock price are exactly the kind of things that might affect the employee's paycheck. So now you have two vital components of their overall financial plan, which are both tied to the fate of this one company. So that right there, that is concentration risk, right? That is correlation. We have two important things in the person's life that are very correlated to one another. And ideally, in financial planning, we want to break up correlations as best we can. Another question is quite simply, can Yogis, could an individual's balance sheet and cash flow handle the ESPP plan? Meaning, sure, if you divert 10% of your paycheck into buying company stock and you plan on holding it for a while, well, can you afford to get rid of 10% of your paycheck every month? Maybe, maybe not. Are you going to face any sort of liquidity needs in the meantime? Are there any sort of selling restrictions that you need to be aware of? Some ESPP plans aren't quite as flexible as others. So anyway, most of the time, an ESPP is an interesting benefit because in most cases, the simplest way to benefit from an ESPP is to buy the stock at a discount today, immediately turn around and sell it. Sure, you're sacrificing a little bit of your benefit because you immediately have to pay taxes, or one way or another, you're going to pay taxes on the benefit you've received, but you're still going to get to pocket some of the difference. It's a good way to get a little bit of an arbitrage, and it's a nice little bonus from your employer. So Yogi, good question. Thanks for sending it in. Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you, but I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no-strings-attached subscription at bestinterest.blog. The next question comes from Jacob. Jacob's question, in short, is how diverse do one's investments need to be? Jacob describes he and his wife's scenario. They have money in Roth IRAs and 403bs. In the Roth IRA, Jacob owns an oil and gas ETF. He owns a healthcare mutual fund, and he owns an AI/tech mutual fund. Whereas some of his other accounts, his HSA and his Roth 403b, are more diversified across, say, Vanguard S&P 500 index fund, target date retirement funds, a balance of U.S. companies, U.S. mutual funds, and international mutual funds. And so Jacob's question, in short, is, how diverse do I consider his particular portfolio to be? Is he relatively safe? Is there anything he should consider adding or changing to have more diversification? Excellent question. Excellent question. So I read through Jacob's situation, and there's a few thoughts that come to mind. So first off, for a younger couple, I believe Jacob and his wife are 32 years old, and they're thinking of retirement, in most likely in 20 plus years. They should be thinking long term, and having 80 or 90 or even 100% of their money in the stock market can make sense. There's a bit of personal preference there, right? About how much risk they want to take and how much volatility they can handle. But in short, they definitely want to have a large proportion of their assets growing for the long term, and the stock market likely makes sense. Now, the devil's in the details a little bit, because when I hear things like a third of his account, I believe it's his Roth IRA, a third is in an oil and gas ETF, a third is in a healthcare mutual fund, and a third is in a tech/AI mutual fund. While it's helpful understanding what types of assets those are, there are many, many different healthcare mutual funds out there. There are even many, many different U.S. large cap growth funds out there. The devil's really in the details. So my initial recommendation would be, rather than focus on sector specifics, to choose a more broadly diversified, low-cost solution. Since Jacob mentioned Vanguard in his question, a good example of what I'm talking about there would be something like VTI or VT, which are two very low-cost, very broad, diversified Vanguard index ETFs. So if someone came to me and they said, Jesse, I'm 35, I have $1 million, and it's all invested in VT. Are there any problems there? I'd say, well, not really, right? There might be some small ways to make improvements. There might be some diversification recommendations that I certainly would have in my portfolio, and I would recommend to others. But one thing I really don't want to do is make perfect the enemy of good. And being invested in an index ETF like VT or similar, that's a very good thing. When I look back at Jacob's situation, his Roth IRAs likely have infinite investment flexibility. So I think a fund, an ETF like VTI or VT, would be available for him in his Roth IRA. And for those of you listening, quick aside, something to be careful of here is that depending on where your assets are custodied, certain funds might have fees associated with them that you really don't want to pay. And an example would be, the FI community is it's a bit of a cliche, this idea of, it's called VTSAX, right? It's the Vanguard Total Market index fund. It's a mutual fund, not an ETF. And if I tried to purchase VTSAX at Schwab or at Fidelity instead of at Vanguard, Schwab or Fidelity are going to say, yeah, that's no problem, Jesse, but we have to charge you a fee because Vanguard charges us a fee to make that transaction here. And instead, Schwab and Fidelity have their own versions of VTSAX that are ostensibly exactly the same, except when you buy them on the home platform, there's no extra fees charged. So one thing to be just a little bit careful or wary of is try to hold the home team's funds at the home team's brokerage just to avoid little fees that might be eating away at your proceeds in a way that you aren't expecting. Jacob, your HSA might have the kind of flexibility that your Roth IRAs have. I'm not sure. Now, my personal HSA is through Fidelity, which from what I've read, there's a great, I think it's a Morningstar report that talks about all the different HSA providers out there. Fidelity is the top. They get great grades every single year. And the nice thing is that Fidelity provides infinite investing flexibility to me. So I invest my HSA dollars in Fidelity's version of the VTI, in Fidelity's version of the VTI index. Jacob, your 403B likely does not have that much flexibility. 403B is similar to a 401k. It's a retirement account. Quite often in these retirement accounts, the investing options are quite limited, 15, 20 funds, something like that, which on net is probably a good thing because a lot of people out there, the average person, just think about the average person. And if you showed them 500 different mutual funds to invest in, what are the odds that they make a good decision? Probably not great. But if you limit it to 5 or 10 or 15, at least they have a better probability of making a good decision. So Jacob, depending on the 403B plan, you might be able to transfer that 403B to a Vanguard or Fidelity. There are a lot of different custodians or administrators who work with 403Bs. If you can, I would recommend you consider that. 403Bs aren't necessarily made in the best interest of the employees themselves. It's a real shame. Having a 403B account at Vanguard or Fidelity is about as good as you can get. And this just brings me to a slightly broader conversation because Jacob's question is about diversification. And the real question is, what does diversification look like? So to me, diversification looks like exposure to many different asset classes, to different sectors within those asset classes, and to different geographies within those asset classes. So again, an asset class might be stocks versus bonds. But then a sector within those asset classes might be, well, are we talking about high tech growth? Are we talking about dirty value stocks? Are we talking about the momentum factor in stocks? Are we talking about big companies, small companies, US companies, European companies? If we're talking about bonds, are we talking about high grade federal, US government bonds? Are we talking about corporate bonds? Are we talking about municipal bonds? Everything. So that's what diversification looks like to me. To achieve that kind of diversification, I don't think we need to seek out individual sector ETFs, like the oil and gas ETF, the tech, the medical ETF that Jacob holds. Instead, I think we can get away with the broadest of funds that hold everything, and do so at a very low cost and are pretty simple to conceptualize. And the answer there is something like an index fund. Again, I do believe that there are helpful ways to improve upon a purely index fund portfolio. And as I've written about before on the blog, I can't remember if I've talked about it here on the podcast, not every index fund portfolio is built the same. I could sit here and say, yeah, I own nothing but index funds. I'm 100% invested in the triple Qs, which is a NASDAQ index fund. Well, that's pretty concentrated in tech US growth stocks. There's no international diversification there. There isn't even really a US diversification there, but it is all an index fund. So again, index funds in and of themselves don't necessarily make a portfolio. But if someone were to come to me with 100% of their money in VT or a similar very broad index fund, I'm not going to look at them and say, oh, my God, you're doing it all wrong. No. You're doing it pretty darn right. It's a good solution. Question number 4 today comes from Maple Leaf, writing in from Vermont. And Maple Leaf said, I'm turning 65 this year and will be applying for Medicare. There's a 2-year look-back period of income to determine Medicare tax rates. I have a large equity in my house and I want to sell. I was advised to wait until I fully retire so my income is lower and won't have to pay extra Irma taxes. Is the 2-year look-back period only a one-time event when you apply for Medicare? Or is your annual income reviewed every year for Medicare Irma taxes? Thank you. First off, one thing to keep in mind here is that Some transactions, especially when we're talking about home sales, aren't reportable to the IRS. They're excluded from gross income. If an individual sells their home, the first $250,000 of capital gains is excluded from gross income. And for a married couple, the first $500,000 of capital gains from the sale of a home is excluded from their gross income. That's something to be aware of there, Maple Leaf, when we're talking about the specific question here of selling your home. But we have to do something else. We have to define some of these terms here, because what are we talking about? Irma? What Irma taxes? Medicare taxes? What's going on? So yes, Irma used to be the name of the great-grandmother character in your, B- fiction story from 11th grade English, but no longer. Today, Irma has been given new life that was probably covered by Medicare. IRMAA, income-related monthly adjustment amount. It's a Medicare premium surcharge imposed on higher income Medicare beneficiaries in addition to their standard Medicare Part B and Part D premiums. In other words, everybody pays into Medicare if they're collecting it, right? Everybody 65 and older who's on Medicare has to pay premiums on their Part D and Part B. That's B as in boy, D as in dog, those parts of the Medicare plan. So everybody pays premiums there. But if you earn enough, if you're higher income, you essentially there's a surcharge. You pay even more. And that amount is called IRMA. It's determined based on an individual's modified adjusted gross income, MAGI, which is a federal income tax term. And yeah, it can result in higher healthcare costs for people with higher incomes. So in plain English, higher earners pay more for Medicare. Now, a good question. How painful are these IRMA surcharges in the first place? Well, there's an article that we'll throw in the show notes. That article contains a table, and the table describes what the IRMA surcharge is based on how much income you've earned. So for 2023, the normal Part B premium was about $165 a month. And then there's 5 tiers of IRMA above that. It goes from $165. The next level up is $231 a month. Then it's $330 a month, and it goes all the way up to about $560 a month. So yes, if someone earned $500,000 or more as a single tax filer, or $750,000 or more as a joint filer, instead of paying $165 a month for Medicare, they're now paying $500 a month. And when I see something like this, I'm of two minds, because yes, I believe in frugality. The best interest is, a penny saved is a penny earned. And why pay $1,500 a year, $3,000 a year, $5,000 a year extra if you can try to plan around that? At the same time, if you're earning $200,000 or $300,000 or $400,000 a year in retirement, again, this is income you're earning in retirement, which can be realized income from, say, an IRA or from Social Security. So we have to think about where retirement income comes from. But still, if you're living off of that much income in retirement, do you need to stress over a $1,500 annual line item or a $3,000 annual line item? Personally, I'd be pretty stoked if my retirement modified adjusted gross income was $200,000 or $300,000 or $400,000, right? It's a sign that my financial life turned out to be pretty darn good. I don't think I'll mind the IRMA. And, the people who are most likely to suffer IRMA are also the best positions to deal with it. So it's just good to keep that in mind. Now, as Maple Leaf alluded to, there's a 2-year delay in the IRMA math. So in 2023, to determine who owed IRMA surcharges, they looked at 2021's income. Here in 2024, in order to see who's paying IRMA here in 2024, the IRS and the Medicare administration, they're looking at your 2022 income. So for retirees, there's this look back period. And right now in 2024, the question is, well, what will the 2026 IRMA brackets look like? And how do we avoid paying IRMA? In general, the IRMA brackets have increased steadily year over year, adjusted by inflation, similar to the way that other things in the tax code increase steadily year over year. Now, that all being said, the 2-year delay in IRMA math means that you might get IRMA'd early on in your retirement. So imagine retiring at the end of 2023. It's the peak of your career. You and your spouse earned a combined $300,000 that year. And now you're just settling down, grooving into retirement. And so like all U.S. citizens, you end up signing up for Medicare just before you turn 65. Come 2025, Uncle Sam and Aunt Irma, they're going to look back at that 2023 income when you were working in full. They're going to see that you earned $300,000 of combined income, and they will put an IRMA surcharge on you. But the good news is that most likely, once you're in retirement, 2024 income is probably going to be quite low in comparison to what 2023's was. In fact, most of your retirement years, you're going to have pretty low income compared to what your highest earning working years were. So the Irma premiums will decrease or maybe drop off completely once the 2-year look-back window is looking at your retirement years instead of your working years. So going back to Maple Leaf's question, the 2-year look-back period is not a one-time event when you apply for Medicare. Instead, it's an annual event. It's reviewed every single year with a 2-year look-back window. And so there will be some years where you pay Irma premiums, maybe. There will be other years where you probably won't pay Irma premiums, or at the very least, if you are paying Irma premiums every single year, the amounts are likely to change. If you're looking back on a very high earning year, just like, the last year that you worked, you're probably going to pay a relatively high Irma premium. But once the look back period is looking at your lower earning years, like your retirement years, you're probably going to have a lower Irma premium. And one more note, this is after all a financial planning podcast. Roth conversions and RMDs are important to remember here, right? RMDs, required minimum distributions, they're forced and they count as income. And that has the potential of forcing Irma upon retirees as they age. So to answer a previous terrific reader question, Roth conversions can help here. You can use Roth conversions to potentially shift the realization of income from high income years into lower earning years that either will prevent or mitigate Irma in the process. But once more, you want to make sure the juice is worth the squeeze. If a 75-year-old has a $200,000 RMD and that, hurts them on Irma, you have to ask yourself, well, where does a $200,000 RMD come from? And the answer is it's coming from an IRA that has over $5 million in it. So should someone with a $5 million IRA be losing sleep over Irma? Probably not. Here's a quick ad, and then we'll get back to the show. A few of you occasionally inquire about two different topics that are actually related. The first type of question seeks out details about my professional life and the wealth management firm that I work for here in Rochester, New York. The second type of question involves the best interest, which operates with no advertising, no pushy sales, no paywalls. And the question is, how can the best interest stay afloat? Well, to answer both of those questions, I want to point you to episode 78 of the Best Interest podcast. I intentionally recorded episode 78 to shine light on those topics and inform you how you can actually help the best interest if you're so inclined. So if you've ever been curious about the business of the best interest, please go listen or download episode 78 and let me know what you think. The next question comes from Jimbo. Jimbo writes in from Alabama and says, Jesse, I want to ask you about the term fiduciary and how it applies to interviewing financial planners. I understand that you are a fiduciary, and I know I should ask prospective planners or advisors if they are a fiduciary. But the more I read, the more it seems like the fiduciary question is a very coarse filter, and I need to dig deeper. Do you agree or do you disagree? And can you add some of your color or unique thoughts? P.S. The Best Interest podcast is wonderful. I know you're busy with your professional clients and a new baby, but if you had time and resources to create more episodes more frequently than every other week, you would 1000% have my vote. I'm sure others agree with me. Well, Jimbo, thank you for the question, the kind words. And listeners, that actually brings up an interesting point. If you'd prefer to hear my voice every single week, let me know. I certainly see the way that this podcast is growing, and I'm very thankful for you listening, sending in feedback, asking these questions. And it is a ton of fun. But yes, it does take quite a bit of time and effort on my end. I want to keep the quality as high as I can. And so to produce an episode every single week would certainly mean that I have to use time that I'm currently using elsewhere in life, and something else in life has to be sacrificed to put out an episode every single week. But that's the nature of life, right? We all get to choose what to do with our hours. And this podcast is tons of fun, and it is growing really fast. So if you're interested in hearing episodes every single week, I will certainly consider it. So please write me an email and let me know what you think about that. Now, as for Jimbo's question about that word fiduciary, yeah, what a great question. Fiduciary duty refers to a legal or an ethical relationship of trust between two or more people or parties. Typically, it involves one person or party acting as a fiduciary. That could be financial advisor. It could be an attorney, an accountant, a corporate board member, something like that. And then the beneficiary of the fiduciary duty, which might be a client Or in the case of a corporate board, it might be a shareholder of the company who receives the benefits of someone acting as a fiduciary. Fiduciary duties are considered amongst the highest standards of care in law. There are some divisions. Depending on where you ask and what you look up, there are different kind of duties that fall under the fiduciary relationship. There's the duty of loyalty, which says that a fiduciary must act in the best interests of the beneficiary, avoiding any conflicts of interest. The fiduciary must prioritize the beneficiary's interests over their own. There's a duty of care, which says that a fiduciary must act with a certain level of competence and diligence and must make decisions with a care that a reasonably prudent person would take in similar circumstances. The duty of good faith. The fiduciary must act honestly and with integrity in all dealings with the beneficiary, ensuring that all actions are made in good faith. The duty of confidentiality. The fiduciary is required to keep the beneficiary's information confidential and not disclose or misuse it without the beneficiary's consent. The duty of disclosure. The fiduciary must disclose all relevant information to the beneficiary, particularly anything that could affect the beneficiary's interests. The duty to act within a scope of authority. The fiduciary must act within the powers and authority granted to them by the beneficiary or under the law. And then lastly, the duty to avoid conflicts of interest. The fiduciary must avoid situations where their interests may conflict with those of the beneficiary, or they must fully disclose and manage any potential conflicts as they arise. So yes, the firm I work for here in Rochester in upstate New York, we're federally registered with the SEC. Part of the relationship that we opted into is that all of our client-facing financial professionals, so that's our CFP planning team, CFA portfolio managers, our relationship managers who act as the quarterback of the client relationship, everyone who's providing financial advice to clients, we all must uphold the fiduciary relationship with our clients. Going back to Jimbo's question, asking if your potential advisor is a fiduciary is an important filter. It's a great question to ask. I think you need to ask that question and hear a good answer. When someone is not a fiduciary, you should have, what might be going on? Well, in my opinion, the biggest issue there is that they might not have to disclose some obvious conflicts of interest with you. And typically those conflicts are related to how the advisor is getting paid or how that potential revenue might affect the advice that they give you. Some examples. Is the advisor collecting commissions on trades? So are they making trade recommendations to you because it's what's best for you or because that's how they collect their commissions? They collect commissions on specific mutual funds. Again, is that what's best for you or is that just the way that they end up getting paid? They could collect 12B1 fees from specific mutual funds. Again, are they going to make recommendations because that's the right fund for you or because it's how they get paid? They might collect commissions from insurance products or from annuities is a very common one. They might collect referral fees by sending you and your business to specific professionals, insurance professionals, accounting professionals, et cetera, et cetera. Again, the fiduciary shouldn't be doing any of these things in the first place. It violates the duty of loyalty, the duty to avoid conflicts of interest. But if someone isn't a fiduciary, technically speaking, they could get away with saying, well, sure, I collect a fee here. I also think it's right for you. Well, it's certainly a conflict of interest. It might be true, but it's definitely a conflict of interest and ought to be talked about. But even then, and this is where I really think the rubber hits the road with Jimbo's question, even if you are working with a fiduciary, Jimbo's right. It's a bit of a coarse filter. There's a murky territory here. And here's an example. If you've listened to this podcast for a while, you've heard me talk about the fact that I find annuity products to be numerically indefensible. I can't make the math work. I've never been able to make the math work. I've never recommended an annuity to a client. The fees are typically atrocious and the returns just don't meet the mark. There's no way that I can justify the math. But what if another advisor out there truly and honestly believes that the safety net or the security blanket aspect of an annuity is so beneficial to a client's mental health that it's worth pushing the client in that particular direction? Now, that advisor might look at what I say here, and they might say something like, well, Jesse's hard-headedness is preventing him from recommending annuities. His devotion to math, his refusal to look at the soft side of things, he's preventing good advice to his clients. Is he acting as a fiduciary? Someone could convince themselves to say that. And sure, I would look back at them saying, and I might say to them, well, are you sure that the fat annuity commission isn't clouding your judgment? But the point being is I know I've had a conversation with someone who is a fiduciary who I know, who recommended what, in my opinion, is straight up bad and conflicted advice around annuities. Now, I would say I'm coming to it from an objective argument point of view. They would say there's a subjective aspect to this particular topic. But the real point here is that, going back to Jimbo's question, the fiduciary question alone isn't a perfect or complete filter. You still have to figure out a way to dig a little bit deeper. In my opinion, you should still ask an advisor questions about their investment philosophy. You need to ask them questions very, very specifically about how they get paid. And feel free, see what the advisor says. But I've had people ask me questions about how my firm gets paid. What is the relationship? What is the fee relationship between the firm and the client? I've also asked people about how I get paid. What's the pay relationship between the firm and Jesse? How are those incentives aligned? Because I think that's an important one too. You should ask your advisor about all the types of non-investment services that you might receive. Detailed financial planning is one really good example. Because again, if an advisor is only getting paid based on the trades or the mutual funds that they push you toward, they might not have an incentive to actually provide you any other ancillary financial planning services. So it's a bit of a rabbit hole, the fiduciary question. But Jimbo, great question. Thanks for listening. Anyone listening, let me know what you think about the whole fiduciary situation. And we end with a great question from Eric, the last question of the day. Eric's got a cool one. Eric and his wife are both 38. Eric would like to retire at 55, but his wife really enjoys her job, and she probably isn't going to want to retire until 65. So the whole idea here is when you have two people who are retiring at very different times in their life, how do you untangle that? What do you have to deal with? And a couple examples. Eric mentions the Roth conversion ladder, which sounds great for an early retiree, but it's complicated by the fact that his wife will continue earning, that she's going to be a high earner, and that's going to keep them in a high tax bracket, which messes with the ability to do Roth conversions. But on the flip side, a lot of early retirees have issues paying for health care before Medicare kicks in. Well, in Eric's case, his wife is continuing to work. He can essentially mooch on her health plan. Well, that's terrific. So Eric's question is, what else should he be thinking about? These potential pitfalls, I should say, where he's retiring early, his wife might not be. Are there any benefits or opportunities that he should take advantage of? And what are some of the conversations he should be having with his wife to plan this out? So Eric, I think you need to start with a cash flow analysis. If you plan on retiring at 55 and your wife is planning on retiring at 65, why don't you try to project all the inflows and outflows of money that'll happen in your life between ages 50 and age 70? So that starts with 5 years of you both working, and then it's 10 years where, Eric, you're not working and your wife is, and then it ends with 5 years where neither of you are working. And the question is, during the periods where your wife's working and you're not, how much are you going to need to draw on your portfolio specifically? I think you can actually run the numbers and do the math. And with her still working, I'd wager that your withdrawals are going to be less than you think they need to be, especially if she's willing to share her income with you to support your lifestyle. So long as once you're both retired, you're going to share your retirement accounts with her to support your retired lifestyle. I think it'll work out that way. Looking into Social Security strategies, I'd say use some of the ideas I shared here earlier in this episode. It's quite likely that it could make sense for you, Eric, to start collecting Social Security early and for your wife to wait until age 70. Although it is worth understanding the interactions here, because you collecting early, it might end up getting in the way of potential Roth conversions that you'll want to do, the Roth conversion ladder that you mentioned. And speaking of Roth conversions, yes, if your wife continues to work and that you're married and filing taxes jointly, then it's not going to be ideal for you to do any Roth conversions or a Roth conversion ladder. For those of you who don't know, Roth conversions make the most sense when you're not earning much income, which for Eric, it's true, he won't be earning much income, but if his wife is really a high earner and they're filing taxes jointly, then their joint tax return might show a lot of income on it from her, which does mitigate Eric's opportunity to make Roth conversions, but that's not the end of the world, right? We kind of talked about this before with the whole Irma math. If you're earning $500,000 a year, and because of that, you have to pay Irma taxes, it's like, well, you're still earning $500,000 a year. And essentially the problem here would be for you, Eric, well, I can't perfectly execute this particular tax loophole strategy because we're earning too much money, right? I think most people would trade places with you. I know it's not ideal. It's not ideal, but it's also certainly better than some other scenarios. But I do think there's something really important for Eric to keep in mind. Now, Eric, perhaps you can look ahead and start to think about certain years. And this is where the cash flow analysis, I think, is going to be really helpful. hopefully you will see that there are certain years where perhaps neither of you are working, perhaps neither of you are collecting Social Security yet, or if you are, maybe it's you, Eric, and it's a relatively small amount. And there will be some years where you can probably squeeze in a lot of Roth conversions onto your federal tax return at a relatively low tax rate. I would look into that. And yeah, being on your wife's health insurance is a huge plus for your years, right? You're going to save a lot of money in your early retirement by doing that. From a strictly financial standpoint, I think there are far more benefits to you, Eric, than there are downsides. You'll essentially be living a FIRE lifestyle while also earning half income as a couple, which is certainly going to be good for decreasing any needed withdrawal rate from your portfolio, Eric. But, okay, I do think there's one important, vital conversation or consideration, Eric, that you and your wife need to make. And it's a joint consideration. There's the question of, what is it like to have the freedom and flexibility of early retirement while your spouse is still working a 9-to-5? Or from your wife's point of view, what is it like to be working a 9-to-5 while my husband is retired and he's going to do his retirement thing all day? And this idea, it comes from a cool study that Fritz Gilbert and another gentleman did, Fritz Gilbert from the Retirement Manifesto, where they interviewed a whole bunch of pre-retirees and post-retirees. And they found that the number one concern for pre-retirees had to do with finances. The number one concern for pre-retirees had to do with finances, but that finances aren't even close to the number one concern for post-retirees. Other things like, how am I going to find fulfillment? What am I going to do all day? How is my health doing? Those are the kind of things that post-retirees think about. How are my relationships? How am I doing socially? How's my relationship with my spouse? And I think retirement is this jolt to the system. It's a big change. And of course, there's a ton of positives, but there also might be some negatives associated with it. And I think it's going to be really important to have some clear communication with your wife, Eric, about how might that look? And how's it just going to change the daily rhythm where, sure, right now you're both working the 9-to-5 and you see each other in the morning and then you have dinner together at night and you walk the dog or, whatever your rhythms of life are. And now all of a sudden it's really going to change where it's not that you're not doing anything. Of course, you're living your retirement dreams, but from her point of view, it's going to be that you're kind of putzing around all day. You're puttering here, puttering there. Maybe you're going on trips. Maybe you're going on adventures. You're pursuing some of your passions, but you're not working. And it's going to alter some sort of rhythm that you've kind of fallen into as a couple. And there are a lot of stories out there where people say, yeah, like I thought retirement would be this. I was dead wrong. It wasn't what I expected. In some ways it was better. In some ways it was worse than I expected. Either way, I had to make some big changes, or we as a couple had to make some big changes. And so, Eric, from some of the details that you shared, I'd be surprised if finances end up being an issue for you in retirement. As I talked about on episode 89, I'm sure there are some ways where you can tweak and optimize your finances. The question is going to be, is it worth the time and effort and the resources that you'll have to put in to do so? It might be, right? Everyone can benefit from some optimization. But I think a much bigger question mark is the relationship question mark of just saying, are you and your wife going to be on the same page? How are you going to execute it? What's it going to look like over that 10-year period? 10 years is a long period of time. But either way, good for you, Eric. Sounds like you're doing really well. It's a cool problem to deal with, right? It's a good problem to deal with, and good for you for thinking about it 17 years in advance. So everybody, thank you for listening to this episode 90, this third AMA episode of the Best Interest Podcast. If you have questions that you want to contribute to a future episode, just email me, jesse@bestinterest.blog.
Thanks for tuning in to this episode of the Best Interest Podcast. If you have a question for Jesse to answer on a future episode, send him an email at jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves, and we really appreciate it. We'll catch you on the next episode of the Best Interest Podcast. The Best Interest Podcast is a personal podcast meant for education and entertainment. It should not be taken as financial advice and is not prescriptive of your financial situation.